This podcast provides general information only and does not take into account your objectives, financial situation, or needs. It is not personal advice. Views expressed may not reflect NetWealth, and NetWealth may receive fees for products discussed. Please seek professional advice before acting.
Welcome to the NetWealth Portfolio Construction Podcast, brought to you by the NetWealth Investment Research Team. Join us as we speak with key wealth management professionals to uncover opportunities and challenges on a diverse range of topics.
What all this really means is that it really highlights the importance of private equity fund managers to take an active ownership approach in order to be able to work together with the management teams of their portfolio companies to drive that fundamental organic as well as M&A-led growth that is really what we believe is going to be the drivers of returns in the current environment.
With your host, Paul O'Connor.
Good morning all, and thanks for joining us on the NetWealth Portfolio Construction podcast series. For new listeners, I'm Paul O'Connor, and my role is as Head of Strategy and Development for Investment Choice for NetWealth. Today we have Gabriel Ng from Neuberger on the podcast, and Gabriel is a Managing Director of Neuberger and Co-Program Manager for the Global Private Equity Access Strategy. We'll discuss global private equity with Gabriel, which in recent years has taken a back seat courtesy of the exposure and focus on the growth of private credit. But private equity, or PE, can play a key role in generating long-term growth in a diversified portfolio. Neuberger Berman Australia is a wholly owned subsidiary of the Neuberger Berman Group, which was founded in 1939 as a privately held and employee-owned investment management firm. The Neuberger Group offers capabilities across a range of asset classes, including equity, fixed income, quantitative and multi-asset class, private equity and hedge funds. The Neuberger Group has over US $560 billion in assets under management and has offices across various major regional locations and a diversified client base that spans institutional investors, advisors, and individual investors. At present, the Neuberger Group employs approximately 2,900 employees with 779 investment professionals globally. As mentioned, Gabriel is a Managing Director of Neuberger, and prior to joining Neuberger Private Equity in 2018, he was part of the GIC Private Equity Funds and Co-Investments Group, where he focused on global secondary transactions. Previously, he worked at Providence Equity Partners in Hong Kong, where he focused on buyout and growth transactions across the Asia-Pacific region. Gabriel also worked at the Bank of America Merrill Lynch in the Asia M&A Group. He received a BS in Economics with honours from the Wharton School at the University of Pennsylvania. There are three Neuberger funds on the NetWealth Super and IDPS menus, being the Global High Yield Fund, Strategic Income Fund, and the Global Private Equity Access Fund that Gabriel works on. There's an increasing choice for investors when it comes to private equity strategies, with more evergreen or open-ended options available to investors. PE risk varies materially, though, across the sector, with venture capital being the earliest stage and highest risk PE investment, growth equity, buyouts, distressed and special situations, through to secondary. So understanding what a PE strategy actually invests in is really the key to understanding the risk-return characteristics of that strategy. Investing in PE does significantly, though, increase the opportunity set for diversified portfolios. Their equity exposure can be expanded materially, as most companies in the world are private, and with the low number of listed exchange IPOs in recent years, it certainly makes sense to consider an allocation from a portfolio construction perspective. However, it's also important to consider the illiquid nature of the sector, the use of leverage, and diversification in a strategy before investing in private equity. Maybe for starters, Gabriel, for our listeners not familiar, can you give us a brief introduction to the Neuberger Private Equity platform?
Hi, Paul. Well, good day to you, and thank you for having me on the podcast. So at the firm level, Neuberger is a privately owned asset manager with over 560 billion of AUM across various asset classes, including public equities, fixed income, and private markets. Approximately 1/3 or about 180 billion of the firm's AUM is in private markets, which span private equity, private credit, and other alternative specialty strategies. So within private equity itself, we have over 30 years of investment experience and have built strong moats and relationships over a long period of time. We also have a well-resourced global team across the US, Europe, and Asia-Pacific markets. And in private equity, we focus mainly on primary fund investments, direct co-investments, as well as secondary transactions. And I would say that we're active investors in this asset class, having committed over 30 billion to private equity investments and funds in the past 3 years. Also worthy to note is that we're on the advisory board of over 450 private equity funds, which is a testament to us being an important and strategic LP to our private equity fund managers.
The AI sector is investing heavily over all areas of the value chain at present, from hardware and infrastructure through to end-user applications, as I guess highlighted by Microsoft, Alphabet, Amazon, and Meta, that are projected to invest US $725 billion this year, which is up 77% on last year. So, Gabriel, do you have any concerns over that huge flood of capital pouring into the sector?
I would say that this space is indeed rapidly evolving, but overall, if we take a step back, I think we're still relatively early in the whole AI technology build-out phase. Many of the companies or hyperscalers that you had mentioned in your question also operate profitable business segments outside of AI, right? And which together with some, debt issuances, right, provide them with the capital to continue to build out the AI infrastructure. All that being said, the long-term aggregate return on all of this AI infrastructure investment still remains to be seen and needs to be closely monitored. I think there's some parallels out there, right, being drawn to the dot-com bubble. But so far, I don't think we're seeing any potential red flags or warning signs or stresses in the system as yet. And actually, in spite of the huge amounts of capital wanting to be deployed into this space, into AI, there could also be potential constraining factors, right, which may put a bit of a natural speed bump in the build-out and AI spend. For example, the availability of electricity, chips, and also skilled labor, right, to build out all these new power plants and transmission lines, which are critical for this infrastructure build-out.
Certainly significant, isn't it? That whole value chain. And I guess from, we're starting to see more end user application development, but the actual land, the power, the electricity, the water. So I can certainly appreciate your view that it's still early in the build out phase. I guess I was just a bit concerned if, typically when you throw a lot of capital at a sector, some of it will potentially not be productive in its use there. But I do appreciate that, this is a long-term theme and trend that is only going to continue to grow, I think, over the next few years. Given the pace of AI advancement from more capable foundation models to accelerating enterprise adoption, how are you thinking about the implications for private markets, both in terms of where capital is being deployed and how AI is reshaping the competitive dynamics and valuation frameworks of portfolio companies?
So I would say that we actually continue to focus on investing behind traditional defensive sectors, but at the same time, right, we too are selectively investing behind some of these exciting long-term mega growth trends, and AI is certainly one of the key themes and at the forefront, right? This includes AI foundational models, data infrastructure, as well as AI enablement, right, which ranges from services to critical components, data centers, connectivity, amongst many others. And exactly to your point, we're starting to see many use cases in several areas. For example, the automation of processes, customization of solutions, right, across products and services, enhancement of decision making, right, and improvement of employee productivity, discovery of new insights, cybersecurity, and the list goes on, right? But ultimately, for private market investors, AI implementation, we expect should drive competitive advantages that lead to sustained top-line growth as well as profit margin improvement, which hopefully in turn should translate into an increased valuation of the portfolio companies of these private equity funds that implement AI into the day-to-day operations. All this is easier said than done, but it does require a very systematic and structured approach, right? Starting first with the leadership buy-in, right? Recruiting the right talent, and ultimately the implementation and execution. And given the pace of change and evolution, right, this is indeed leading to increased competitive intensity, right, as companies need to be on the front foot, right, in terms of leveraging AI in a way that helps them to maintain an edge over their competitors.
A key component to better performing PE strategies is obviously deal flow. So how would you describe your current state of opportunities, and what are the most important factors you focus on when assessing an opportunity?
So I would say that, taking a step back, right? So in spite of the broader private equity market moderating in recent years from, the peak levels that we saw in 2021, our deal flow at Neuberger continues to be very robust. And this is really a function, of the broad ecosystem which we have built over 3 decades of investing into the asset class. And perhaps more importantly, our GP-centric model, right, whereby we focus on partnering with our private equity GP partners and providing them with solutions, right, from backing their fundraisers to working with them on co-investments or providing liquidity through secondaries. And ultimately, we want to keep this deal sourcing funnel as broad as we can, so we can be highly selective in terms of backing the GPs or the private equity funds that we like, and also investing in high quality companies in the case of co-investments. So there are many factors that we focus on when underwriting a deal or a fund. Probably too long a list to name, but I think it really comes down to a few things, right? Number one, quality of the companies. Right, the quality of the manager, right? So the question is, we always ask, is a private equity fund the right owner of the asset? And do they have the relevant experience to win in that sector? Valuation of the assets, capital structure, and also the value creation plan and exit pathways, right? So all these are important factors that we focus on in our diligence, and we spend lots of time evaluating them. And I think where we stand today, we too benefit from a very large database of information, right, which is a data repository that we regularly leverage on to help us to make better decisions, right, to draw parallels to some of the investments that we're seeing currently, to do our benchmarking, and ultimately we rely as well on the pattern recognition of our investment committee, right, who have invested together through cycles, right, to guide our overall investment selection process.
Just still on deal flow, has it become more competitive in markets in recent years are we seeing more participants investing in private equity?
I would say yes and no, right? Say, take the case on co-investments, for example, right? I think in a more, I would say, choppy and less benign macro environment, we have seen some participants step back, right, from the space, right? But others have also come in to fill the gap, right? I think what's important in the current environment is the ability to embrace complexity, right? To have a sophisticated on-the-ground team that's responsive, right, to our private equity fund managers, particularly in live situations, right, or in deal situations which are large, right? So I think the ones who have stepped up typically are the more experienced private equity investors, right, with the ability to write larger checks, to participate in these co-underwrite transactions, and to provide liquidity, right, where it's most needed. So I would say that we have seen some market participants retreat, but at the same time, folks like us have become a lot more active.
Do current market conditions provide a head or tailwind to the opportunity creation? And I guess given the wider dispersion of outcomes that PE investments have exhibited over the years, how is complexity being rewarded?
Yeah, so I would say that the private equity asset class has had a great run, right, for the decade plus, post the GFC, where interest rates were low and valuation multiples were generally on an upward trajectory, right? So helping the ultimate exit outcomes. But today we're sitting here and facing a very different macro environment, right? Rates are likely to be higher for longer. We have heightened geopolitical tensions and conflicts, and also a more muted and difficult exit environment, right? But in spite of these challenges, we believe that private equity as an asset class still has the ability to deliver a return premium over the public markets. However, in a more choppy environment, as you mentioned, right, the return dispersions are going to be wider, right? So in a market with greater dislocations and the lack of liquidity, right, to my earlier point as well, we believe that providers of liquidity solutions like ourselves, right, could potentially unlock compelling investment opportunities across various strategies that we focus on. And we're seeing a lot of opportunities, right, in the co-investment space, which I alluded to earlier, right, both in these, larger co-underwrite transactions, as well as what we call, midlife transactions, where our capital goes in to invest into a private equity portfolio company to provide a very specific solution, right? Typically to help the company and our private equity fund managers execute on a transformative M&A transaction, or in other instances, right, to provide a partial equity recap, right, on some of the portfolio companies in their funds, right? And we also see a very, say ample and growing opportunity set in GP-led secondaries, right, with the rise of continuation funds and a lot more, GPs wanting to hold their winning assets for longer. So these are all, right, complex transactions that are not easy to underwrite. But as you mentioned, we expect to be rewarded, right, with the ability to embrace this complexity and to step up to these deals.
Imagine a world where wealth technology is simplified. NetWealth is continually investing in new tools and platform features to optimize your staff productivity and to give you and your clients the best user experience. With our managed accounts functionality, bring new efficiency and scale to your investment operations. A world of technology awaits. Discover it at netwealth.com.au/woo.
Further on that, with hold periods extending and I guess traditional exit routes being slower to materialise that are, I guess, both impacting on distributions, how are the GPs and the LPs using tools to manage liquidity today?
So exits or lack thereof, right, is certainly a challenge that the private equity industry has been, facing in recent years, right? If you look at percentage of annual distributions, right, relative to private equity NAV, right, so that metric has been below the long-term average for the past few years, right? And in terms of navigating this environment, secondaries is certainly one of the strategies that LPs undertake, right, to generate distributions. So over the past few years, we see many large institutional investors in private equity take decisions to sell sizable portfolios of private equity funds. Just to put some numbers around it, right? Last year, LP secondaries, right, accounted for over 120 billion in terms of transaction volume. This compares to roughly about 25 billion of LP secondary deal volume annually, right, around 10 years ago, right? So if you look at the numbers 10 years ago versus today, 25 billion stepping up to 120 billion, that is a meaningful step up, right? So LPs are actively, right, reviewing their portfolio and they're also coming to market to sell, right, some of these private equity fund holdings. If you sort of switch gears and look, to the GPs, right, they are also, adapting to the current market conditions. As I mentioned earlier, we've seen a meaningful step up in these GP-led continuation fund transactions, right, which now account for just under 50%, right, of total global secondaries volume, right? So this is where, a GP looks for a secondary buyer, right, to lift out either a single asset or multiple assets from the existing funds to a new continuation vehicle, right? And, I think this type of transaction does provide their existing LPs with an option to either take liquidity, right, or to roll over into the continuation fund, or even, take partial liquidity and roll a partial stake into the continuation fund, right? So LPs have that option to decide. Right. And for the GPs, right, they, I guess the thesis for them, right, is that they are able to continue to hold on to a familiar asset for a longer time, right, to continue to compound returns over an additional 4 to 6 year period, right? But at the same time, these GP-led transactions are, well, I would say not easy to underwrite. I think as we look at them as part of our deal flow, right? The bar is pretty high, right? First, you have to ensure the alignment is there, right, with the GPs, right? You have to be sure that it's a high quality asset, and an actual or eventual exit route is able to come to fruition, right, over the next 4 to 5 years. And how you set the terms and the structure and the economics, all these are important factors to take into account before we get comfortable, right, with some of these GP-led transactions. On top of all of that, right, in addition to secondaries, there are also a few other ways, right, that GPs are looking to generate distributions. For example, NAV financing and partial, minority recaps of their portfolio company. So I would say that it's indeed a more muted and challenging exit environment, but we see both LPs and GPs evolving the strategies to adapt to it.
It's interesting, I find, that in your comments around the secondaries there that you didn't mention IPOs, whereas probably 10 years ago or so that would be a traditional route then to receive a distribution and unlock liquidity. But it certainly seems to have been a global trend, the reduction in, I guess, private equity seeking listing on exchanges around the world there, Gabriel.
You're exactly right. So we track the breakdown of the exit routes by year, right? How that changes and evolves over the years, right? I would say that, IPO activity, post 2022 did sort of almost come to, almost a grinding halt, right? It was in that single digit, right, of private equity exit routes, right? But I think we've been, cautiously optimistic or encouraged by the IPO markets sort of seeing a bit of a recovery over the last 2 to 3 years, right? I think last I checked, it was in that sort of teens percentage, right, in terms of exit routes for private equity investments. And I think the good news is that, there are multiple sort of options, right, that a private equity investor is able to undertake, right? Oftentimes, in seeking an exit, they might consider dual track exit processes. So on one hand, evaluating the appropriateness of, public markets exit, but at the same time, running a trade sale process, right? Or a sponsor to sponsor transaction. So I think that's one of the benefits, with private equity investments in that, the manager is able to find an optimized way, to maximize value, at the time of exit. But yeah, IPOs continue to play a part, but it's not, I think the vast majority of the exits have really been sale to trade buyers as well as sale to other private equity funds.
Moving to the fundraising environment, how is that currently? And also with the tougher macro landscape, how are GPs navigating this challenge, Gabriel?
Very topical question, Paul. Right. So I think in terms of fundraising, once again, the broader market continues to be challenged, right? If you look at fundraising volumes, at least on a headline basis, right, for the overall industry, right, that's been on a downward trend in the past few years. But at the same time, right, if you sort of compare that to pre-2021 peak levels, right, I think it's kind of in line with that sort of, longer term average, right? And if you, peel back the onion further, you realize that the fundraising is actually fairly bifurcated, right? With established GPs on one hand, right, accounting for a disproportionate amount of capital raised, and these are the GPs with very extensive and strong track records. And on the other hand, right, where we see challenges is really the emerging managers, right, that are, taking much longer, right, to raise their target fund sizes, or, unfortunately with some of them maybe not even being able to sort of hit the target fund sizes. And to share one other statistic, right, the average time that takes to raise a private equity fund has gone from 14 months, right? This is prior to 2022, right, to currently approximately 2 years, right? So that length of fundraising horizon has also lengthened, right? And ultimately, a key consideration is that many LPs, need to see distributions in order to make subsequent commitments to private equity funds, right? So as mentioned earlier, these GP-led transactions, NAV financing, partial equity recaps, these are all ways that the GPs are kind of, leveraging on to manage DPI, right? To, enable them to raise subsequent vehicles with more certainty, right? And I would say that GPs are also, a lot more tactical, right, in the current environment. For example, building dialogues with LPs, right, both existing and prospective ones, much earlier ahead of the fundraise, right? They're waiting for certain exit events to crystallize before formally launching the funds, offering first close discounts or size related discounts, etc. And from an LP's lens, right, from where we sit at Neuberger, we, just given the longer fundraising cycle, right, we're seeing, opportunities to invest into what we call late primaries or partially funded primaries, right? This is where a GP has already started to invest the fund, right, prior to the final close. Coming in at a later stage of the fundraise, sometimes gives us the opportunity to review the first few transactions in the fund, right? And some of the early investments may have also been written up, right, prior to the final close of the fund. So it's a bit more opportunistic, but we're seeing, the ability to invest into some of these funded primaries increase, right, particularly over the last few years.
In terms of consolidation across the industry, what's sort of happening at present?
Yeah, I would say that, very much related to your earlier question, right, in a more challenged fundraising environment, and an environment where scale and greater platform resources may be required for capital formation, deal sourcing, and post-deal value creation, we do see a wave of consolidation taking place in the industry, right? In terms of M&A, right, if we just look at, that aspect, right, transactions involving private market firms had doubled actually in 2024 compared to 2019, right? And the rationale underpinning such transactions, there are many reasons, right? They include, acquiring capabilities in a new asset class, right? For example, we see many private equity buyout firms actually acquiring secondaries focused managers. Right. One other rationale would also be to enter into a new geographical market, right? So rather than build these capabilities organically, which would take a longer time, right? The acquirers have chosen to, acquire a platform and also to onboard a new team. But therein also lies the risk of integration and culture. Right. And the acquirer and also the acquiree has to, be cognizant of, how to manage conflicts and ensure a smooth integration process, create sort of net value, right, for the end investors, all of which needs to be carefully navigated in these M&A transactions.
So it sounds to me like it's really just a natural evolution and maturing of the industry and the sector there, Gabriel. So, which is, I think, just positive really for investors, creating more liquidity also across the sector. PE investing uses leverage to varying degrees, and with higher bond yields increasing the cost of capital, is the outlook for returns more subdued today? I'll also then ask as a secondary question there, what makes for an attractive opportunity set in the current market?
Sure, Paul. Right. I would say that, the target returns, that we underwrite to in a private equity transaction hasn't changed, right? Today, versus, 5 or 10 years ago, right? But the components that contribute to that return, right? That's very different, right, today versus in a low interest rate environment, which we had benefited from, right, post the GFC. What do we underwrite to today, right? And where is the vast majority of the returns coming from? That is really based on fundamental growth, right, in both top line revenues and earnings, right, that's driving that return outcome, right, in our underwriting in the current environment. And in addition to, I guess, organic fundamentals and the growth of earnings, right? One other lever would also be bolt-on acquisitions, right? This is where, a private equity fund manager may sort of buy, or leverage one of its portfolio companies to buy its competitors, right, at a lower valuation multiple than the entry valuation multiple of the original investment, right? So what this effectively does is buy down the entry multiple, right, over time, right, by acquiring and doing these tuck-in acquisitions and growing inorganically. So you might have also seen a much referenced term recently that, in the current rate of environment, right, more like a low double digit sort of rate of earnings growth, right, is required to generate a similar PE style returns, right, compared to a mid-single digit earnings CAGR, previously, right, where you had lower cost of leverage and rising, multiples, right? So what all this really means is that it really highlights the importance of private equity fund managers to take an active ownership approach, right, to be able to build that functional in-house expertise, right, from areas ranging from procurement to talent recruitment, to technology, to M&A, right, in order to be able to work together with the management teams of their portfolio companies to drive that, fundamental organic as well as M&A-led growth that is really what, we believe is going to be the drivers of returns in the current environment.
There's been a demand for discount capture over recent times. So is this something the team look for, and where is the pricing at presently?
Yeah, I would say that discounted LP secondaries are always welcome, right, as a buyer. But, at the same time, we too have to balance it with quality, right? Because ultimately, well, at least for us at Neuberger, we're focused on acquiring secondary LP interest in high quality funds, which we have strong conviction on, right? And we actually aim to unlock discounts, right, through our sourcing networks and our ability to deliver deal certainty, and also being a preferred buyer, right, from a GP's perspective. GPs typically would need to approve such secondary sales, right, and being an important LP in the ecosystem, more often than not, right, we are on that approved buyer list, right, for these secondary LP transactions in the market. Right, I would say that in terms of pricing, the discounts for buyouts is currently, in the mid to high single digit range. But through our, sourcing and networks that we've built over the decades, we have been able to buy at, wider discounts, right, than what, you observe in the general market. Right. So these are some of the modes, and our unique positioning that, we have managed to get, right, after many decades of operating in the ecosystem. And actually, interestingly, if we think about fund structures, our belief is that discounted LP secondaries are more suited, right, to a closed-ended fund structure. And this is because all the LPs in the fund benefit equally from the discount capture. Right. If you look at the open-ended funds or the evergreen funds, right, LP secondaries that are acquired at a discount, arguably would only benefit the investors who are in the fund, right, at that point in time, and not really future investors, right. So that discount capture is not equally shared, right, between current and future investors. And just to complete the picture, right, if you look at GP-led secondaries, at least from our perspective at Neuberger, because we are focusing on, I guess, the winning assets of the GP's portfolio, typically they don't really trade at wide discounts to NAV. But in these GP-led situations, an important metric that we pay attention to actually is the implied earnings multiple, right, which we're paying for the assets or the asset. Right. And so far, we've been able to maintain our discipline and buy well, right? Where you might see, very wide discounts in the GP-led space is probably in the tail end fund restructuring, right? Involving perhaps not so high quality assets that, are not that sought after, but that's not a space that we play in, right? So we don't really take part in these, I would say, a more challenged quality type, tail end fund restructurings.
maybe to finish on the questions, Gabriel, in what you're seeing, are mainly retail investors using evergreen funds, or are you seeing an increasing interest from institutional and maybe ultra-high net worth investors looking for evergreen and more liquid private equity solutions?
Evergreen funds have, I would say, grown meaningfully, right, over the last few years. I don't think it's entirely limited just to retail participation. For instance, right, in our own evergreen PE fund offering, we've actually seen participation from a multitude of investor types, retail, of course, but also through, private bank distribution channels, high net worth individuals, family offices, and also institutional clients, right? So ultimately, it is what works for the end investor, and, whether the structure, right, the underlying strategy, the level of diversification, targeted returns, liquidity mechanisms, and also the manager capability, right? All these have to resonate with the end investor before they commit capital to these evergreen funds. I would also emphasize on the overall education process, right? And the importance of investors, whether it's retail or large institutions, really understanding what they're stepping into, right? Because, if I look at the current offerings out there, there are many, it's pretty a plethora, right, of different funds that are available for investors to commit to, right? Some are more weighted towards secondaries, right? Some have primary investments. Some others might be a bit more focused on co-investments, right? Some offerings are multi-manager, while others are single manager, right? So I think it really comes down to understanding the merits and also importantly, right, what are some of the limitations and the risks, right, before making that final investment decision on whether to invest into one of these funds.
So, Gabriel, we'll draw a conclusion, an end to the podcast, but thank you very much for joining us today and talking through the Neuberger, global private equity platform and the trends and the themes you're seeing in the market, particularly around AI, I guess your comments around the deal flow remains robust, I think is certainly very much a positive. The increasing use of secondaries and for liquidity particularly in the sector, and I guess ultimately that the target returns look unchanged in your opinion. So I'm very much appreciative of your time and your insights that you provided today.
Thank you very much, Paul. Right. Thank you for all your insightful questions as well. And, I greatly enjoyed our conversation. Thanks for having me.
And to the listeners, thank you very much again for joining us on the Netwealth Portfolio Construction Podcast series. And I'll look forward to you joining us on the next installment of the podcast. Have a great day, everyone. Thank you.
Thanks for listening to Netwealth's Portfolio Construction Podcast. Follow the show for future episodes. Leaving a review helps others find the podcast. And for more information and show transcripts, visit netwealth.com.au.